Hi, Bill Ethman here for MoneyEvolution.com. In today's video, I'm going to be talking about the 4 different types of annuities and giving you a comparison between those 4 different types and talking about some of the pros and the cons of each of those. So if you've been watching here in our series, this is a series we're doing all about annuities. In fact, we're going to actually, in the description below here, we'll have a link to some of the other videos in the series and the playlist, so you can go back and watch some of those other videos. So if you've been thinking about an annuity for your retirement, you may be getting a little bit confused or maybe a little uncertain about the different types of annuities and which one might be right for you, or if an annuity is even something you should be thinking about right now. So here in this video, we're going to be going through kind of a high-level overview, and we're going to be looking at each one of these 4 different types. We're going to be talking about the SPIA and the DIA, that's the single premium immediate annuity, and the deferred income annuity. We're going to be talking about fixed annuities, fixed indexed annuities, which is kind of a subset of those fixed annuities, and then variable annuities. And in each one of those cases, we're going to be walking through and talking about the income features that some of those annuities might offer. We're going to be talking about the protections as well, the flexibility, how you can get your money back out, or if you can get your money back out after the money goes in. We'll talk about the fees, of course, that's a big topic there, and then also the growth potential of these different annuities. Okay, so let's start off here talking about the SPIAs and the DIAs, okay? So the best way to think about that is those are the annuities that are kind of like a pension plan, where basically you deposit a lump sum of money with an insurance company, and in return, they pay you a regular stream of income, typically a monthly basis, but it could also be annual. If you want that income to start right away, that's a SPIA, that's an immediate annuity, and if it's delayed, if you say, hey, I'm going to put this money in and wait 5 years, well, that's a DIA. So let's start looking at the different attributes of these annuities, and from an income standpoint, this is really where the SPIAs and DIAs excel, and so that is really going to typically give you the highest check from any of the annuity options, because one of the features of that is that you do give up a lot of the flexibility, all the flexibility, because once that money gets deposited to that insurance company, you no longer have access to that. It's really been removed from your balance sheet altogether. There is one exception to that, is that if you elected for something called a return of premium before the start date, in the case of a DIA, that does, if you elected that, allow you to get your money back, but you're not going to get any interest or any gains in that along the way, but you can take your original premium back before those income payments start. But once the income starts, the flexibility really leaves you pretty much with no flexibility whatsoever. In terms of protection, if we're talking about protecting an income stream, that's going to obviously work very well. It's probably one of the best ways to protect that income stream for the remainder of your lifetime. If you're married, you can also include your spouse in there as well. But in terms of asset protection, again, you don't really have control of that asset, so from an income standpoint, that's going to be pretty good. The fees on these, they're kind of built into the product. I mean, technically, there are no fees. The way that I like to kind of describe that is if you think about like a CD at the bank, and if you go into your local bank and they're going to agree to pay you 2% interest for the next year in a certificate of deposit, technically there is no fee on that, but you know the bank is obviously making some money off of that because they're lending that money back out to somebody else at a higher rate. Well, with the SPIAs and the DIAs, you know, those fees or profits, I guess if you will, are kind of built into the product itself. So I'll just say built in here. And then the growth potential, that's going to just be a big fat, you know, nothing, you know, because there is no growth there. They do, again, this would be an add-on rider. There is an option that in some of these you can have an inflation rider. So you know, that's a possibility, but that's going to come at some type of a cost. Every time you start adding on more features to these annuities, generally they're going to get more expensive there, but that's an inflation that give you some growth there. Let's move on here to the fixed annuity. Okay, so that's going to be most like a CD. In fact, you know, most of these fixed annuities, generally apples to apples, are going to pay maybe a little bit better than a CD, but you're going to give up a little bit for that. So with the income feature, there's a couple different ways you could do that. You could simply, you know, take some of that interest out every year to basically live off of, but there is no guaranteed income stream in most cases. There is the option to annuitize, which is not our favorite option there, because again, once you annuitize, you basically are converting it over here to the SPIA and DIA type of a situation where you're going to then give up control. With protection, so with a fixed annuity, you're 100% guaranteed on principal there. Again, with all of these annuities, you want to make sure that you're evaluating the insurance company that's issuing them, making sure you're sticking with highly rated insurance companies, A quality or better, AA even better than that. So there's generally some good protection there. The flexibility is generally pretty decent. These different fixed annuities, they can have some shorter term time periods, they can have some longer term time periods, but if you wanted to take your money out before that, let's say you bought a 5-year fixed annuity, there generally is going to be some surrender penalties there if you wanted to take your money out before that 5 years. There's also something called a market value adjustment. And what that means essentially is that if, let's say you bought one of these fixed annuities and it was paying you 4% and interest rates went up after you bought that, well, that would be typically a downward market value adjustment. So if you took that money out, not only could you possibly get hit with a surrender penalty, but you could also get a little bit less principal back as well, because interest rates moved against you. So that's something to definitely keep in mind there. Just like the other one, the SPIAs and the DIAs, the fees on these are kind of built in. And technically, there are no fees, but you know, they're obviously making money off of that. And then the growth potential is just going to be somewhat limited. It's going to be limited to that particular interest rate that they've agreed on. So one more thing as it pertains to these fixed annuities is that there's two basic types. There's the traditional type, and then there's something called the MYGA, multi-year guaranteed annuity. And as it pertains to this growth here, with the traditional one, what sometimes you'll see there is you'll see kind of an introductory rate. You'll see something that might even be a teaser rate in some cases, where it could be, you know, something that might be better than what you might see in some other areas. But after that rate expires, it's going to go down to some other rate, either the going market rate, or oftentimes they'll have some limited base rate that they're going to have. The MYGAs, on the other hand, we tend to like those a little bit better, because if you buy a 3-year MYGA or a 5-year MYGA, that's going to generally be the same interest rate locked in over that entire period of time. And then that generally coincides with the surrender schedule as well, so that when that MYGA expires, it's generally at the same time that you're out of the surrender, and then you can basically go out and purchase a new MYGA there. But something to keep in mind there, generally I'm not a big fan of the traditional ones, because those rates can be all over the place there, and you're not locked into that. Okay, so now let's talk about the next type of annuity. It's called the fixed indexed annuity, and technically it is a form of the fixed annuity, but instead of paying you just a rate that the insurance company is agreeing to, your interest rate is going to be dependent on some underlying index. It could be the S&P 500, it could be some other, it could be a bond index, it could be an international index, it could really vary there, and generally you're going to participate in that index maybe up to a cap. So in agreement for maybe protecting you on the downside, it's going to limit your upside as well in there. So, so as it pertains to these things here, income, generally the fixed indexed annuities, they do pay some income as a guarantee, but it's going to be through a rider, and that's going to come, of course, at an extra cost. You know, so these riders can vary from company to company, so you need to look at all the details there, make sure you understand that. But it does have the ability, with a lot of these riders that we see, to guarantee income for the rest of your lifetime. Also for you and your spouse if you're married, and it can pay that income forever. But the baseline of fixed indexed annuities generally don't have that income feature. As far as protection, there is definitely very good protection there, because generally in exchange for maybe limiting some of the upside potential with the fixed indexed annuities, they generally have a base floor of 0, so that even if that index were to go down 5% or 15% or 50%, the worst you could ever do in a year would be 0. And then you know, we'll talk about fees here in a second. Of course, that fee might come off of that. That could push you below that 0. But in terms of just what the market can do, that's generally not going to push you below that. Flexibility, there's, again, just like a lot of these other annuities here, going to be a surrender. The most common that we see on this is a 7-year surrender, but that could certainly be shorter. It could even be longer depending on what type of annuity. And generally, we talked about this in the other videos, and it also pertains to the fixed, and we'll talk about variable here, but when you have that surrender penalty, generally it declines a little bit each year. So it might start off as high as maybe 8 or even 9%, and then every year it tends to go down a little bit. So as you get closer to the end of that surrender period, that's going to be a little bit lower there. And then the fees. So again, that's only going to be for the riders. But probably the most common, we probably see fees for those riders, income related, about 1%. Again, that could vary obviously from annuity company to annuity company. And then the growth potential is, we'll just say okay. What you want to look at as you're thinking about buying one of these things is you want to look at the track record of that index, understand what the cap is, so they can limit your growth by a couple of different features. One would be a cap, and what that means essentially is that regardless of what the index does, you might be limited. So if the cap is at, let's say, 7%, then even if the index goes up 10%, the most you can make in a year is going to be 7. Again, there's that floor in there. There also could be a spread. And a spread, what that means is that's going to be an amount that's going to be deducted from the index. So a spread of 1 would mean that if that index did 7%, they would subtract 1% off of that, and you'd actually earn 6% for the year. And some annuities could have both a cap and a spread. A final one is participation rate. And what that means is that if you're, let's say, investing in the S&P 500, you might have a participation rate of 60%. So if the S&P 500 goes up 10% this year, 60% of that would mean that you would earn 6%. And if the S&P went up 20%, you could earn 12% on that. So participation rate is another way that they're going to do that. And then finally, let's talk about the variable annuity. These probably have, tend to be the most complex of the different annuity types that are out there. Variable annuities can be a very bare bones basic one, and that's basically an investment only with no income or other features attached to it. But if you do have a income feature, that's going to also be at a rider, and that's also going to be at an additional cost. And I'll talk about some of the typical costs on variable annuities here in a second here. The protection, and basically there really isn't any protection on a variable annuity. Variable is, I think of it like a mutual fund portfolio. These mutual funds inside of an annuity are called sub-accounts. They can be very aggressive funds that might be into stocks or international investments. They can be very conservative ones, but generally your investment is not going to have any sort of a guarantee. It's going to be completely dependent on the ups and downs of that market there. The flexibility, again, similar to the other ones, there's going to be a surrender schedule. Probably the most common would be 7 years. Again, some can be longer, some can be shorter. And then the fees. So there's going to be a kind of a bunch of different fees here. All of the variable annuities are going to have something called a mortality and expense. And that could be, 1%. It could actually be more than that. Sometimes maybe it's a little bit less, but you're going to have that. If you've selected any riders, typically we might see a income rider having a fee of maybe another 1% or more on some of those. You could also add in death benefit guarantees. Those could have, be 0.5%. They could be 1% for those. Long-term care riders that can maybe boost that income level if you should happen to go into a nursing home. And then you're also going to have another one for the sub-accounts. So basically those investment options are going to have a fee attached to those, and that tends to be maybe about 1%. So, without even really adding too many bells and whistles to this, you're going to probably see most of these variable annuities at 3% or more. So again, and there could also be admin costs that could be in there. There could be a contract fee. So before buying any variable annuity, make sure you understand all of those different fees and how they work and how they're assessed to your account and everything. And then keeping in mind, what is that fee going to do to that growth potential? So you might see some very good investment options there and maybe some things that have had some great track records. But again, you want to consider those track records in light of, hey, I might have to deduct a 3 or maybe even a 4% fee from that variable annuity, and of course that's going to knock that down. And then depending on some of the riders that you selected, if you selected an income rider, for example, it's not uncommon at all for that annuity to limit the asset allocation of that. In other words, they might restrict how much money you might be allowed to put into some of those more growthy investments like stocks or international investments and things. You might have to keep a certain percentage of that money. So understand that, but generally speaking, the variable does have or tend to have the best upside potential, but again, you're not getting any protection. And then also, look at what is that rider going to do, and some of those riders can be very good. And with all of the income benefits, if that's the primary reason that you're looking at an annuity, you want to look at what is the minimum guaranteed income that this is going to pay out. Not, say, well, hey, if I can earn a X percent on my variable annuity, then I might be able to have this much money in the future. But, just look at what are the minimums that these things are going to pay out, even if the portfolio doesn't do anything like what you expect or hope it's going to do over that period of time. So, so there you have it. Those are the four broad types of annuities that are out there, and some of the features, some of the things to look out for with each of those. Again, this is part of an entire series where we're hoping to educate you about annuities, seeing whether they fit into your portfolio or how they fit into your portfolio. Check out the description links below to check out some of the other videos in the series. And again, if you like what we're doing here, really appreciate it to hit that like or subscribe button. Give us a like on the video, and we'll see you back in one of our future videos. So thanks, and we'll see you soon. Thanks.